Quartiles would divide other data into quarters, fours. Percentiles divide other data into hundreds. Now, think of it here as a salary grade. With the salary grade, you have the minimum of the salary grade, right? You have the midpoint, and you have the maximum. And so from the minimum to the 25th percentile, that's your first quartile, 25th percentile to the midpoint, that's your second quartile. And from the midpoint to the 75th percentile, that's the third quartile, right? Quartile is 4. 75th to the maximum, that's the fourth quartile. So that's what that looks like. And you see here in terms of numbers, the minimum are those that meet the minimum qualifications in that salary grade. The midpoint is usually those that are at 100%, so fully proficient with good performance. Now, those are the 25th percentile, they meet or slightly exceed expectation. The 75th percentile, those are top performers with advanced experience and skills. And those that are put at the maximum of the salary grade, they are long-term with progressive experience, advanced expertise, consistently high performance. And anyone who is on the salary grade that is paid less than the minimum is called a green circle. And anyone who is on the salary grade that is paid more than the maximum is called a red circle. Now let's look at mean, median, mode, and range. So for mean, you add up, it's also called average. You add up all the data points and then divide by the total number of numbers, right? So we have 1, 2, 3, 4, 5, and we have 5 numbers. You add that up 15, divide by 5, which is the number of the numbers, and you get 15 divided by 5, you get 3. The median is the middle value, the midpoint of the data when arranged in order. So you see, we first arranged our numbers in order, 1, 2, 3, 4, 5, and the median is 3. In the mode, the value that appears the most often in this case is 1. The range, the difference between the largest and the smallest value. So the largest is 5, the smallest is 1, the difference is 4. And you have more examples here as well. Now let's look at data analysis methods. We have the variance analysis, which we're going to explain all of these methods in greater detail as we go. And variance analysis identifies difference between the planned and actual performance. We have the ratio analysis, which examines relationships between data in financial statements. Root cause analysis identifies the possible causes for an event or condition. The trend analysis identifies changes in a variable over time. And the scenario or what if analysis identifies the impact on X of different scenarios. Regression analysis identifies relationships between variables and their strength. Now let's look at variance analysis. So variance refers to a difference between two values, and the deviation may be favorable or unfavorable. Now, favorable variance examples include a salesperson's actual sales exceeds his specified target. So his target was maybe to sell 10,000, but he sold 20,000. That is a favorable variance. It could also be current month sales exceeds the last month's sales, right? So that's a good thing. When we make more money, more sales than what we projected. That is a variance, but that's a favorable variance. Now, unfavorable variance examples include a manager exceeds the allocated department budget, so they spent more than they should have. Current month cost exceeds previous month, so the cost is way higher than what we had budgeted for. That's an unfavorable variance example. Now, variance analysis is calculated by these parameters. You want to check the actual results versus the target. You want to check the current results versus the previous results. You want to check the budget versus what was actually spent. And the time period for measuring the deviation or the variance include current month versus previous month, current year versus previous year, first quarter versus second quarter. Now, variance analysis, it's the quantitative investigation of the difference between actual and planned behavior. So, for example, again, if you budget for sales to be $10,000 and the actual sales are $8,000, variance analysis will yield a difference of $2,000. That's an unfavorable variance, right? Variance analysis, it's also a good means for checking accuracy, evaluating the performance, and implementing remedial actions against the weak areas of a business. It's used commonly in schedules and budgets. What did we budget? What did we actually sell? What did we actually spend? What was the difference? Now, in human resource management, variance analysis can be used to identify the difference between planned performance and actual performance. Now, here we have some examples of insightful variance analysis. So one, a comparison of the previous month's actual results with the most recent forecast of the results for that month. So previous month, actual results, and the forecast of the results of that month. And two, we have a comparison of the year-to-date results compared with the year-to-date budget. Three, a comparison of the updated full-year forecast to the full-year budget. Okay, and you see what this looks like: actual sales versus the target sales. So the target sales that we had as our target, those are in blue, and the actual sales are in pink. And you can see that for month of January, the target sales was about right here, let's say 6,500, but the actual sales was way higher, about 7,800. And that is exactly what a variance analysis would look like. And you can see that here as well, the example here as well. The sales revenue, what we had as our budget was 500. What we actually got was 600. That's $100 as a difference. That's favorable. The wage cost, the budget we had was 100. The actual was 90. That's 10 as a difference, which is favorable. The material cost that we budgeted was 200. The actual cost was 300. The difference is 100, but that's adverse because that's costing us more money, right? And you can see the profit, 200. The actual that we got was 210, so that's good. All right, let's look at ratio analysis. We kind of touched on this already when we talked about financial ratio in the part 1 of this video. And so here is just going to be a quick overview. Ratio analysis will aid in the firm's performance, interpreting the firm's performance and financial position. Now, it will use financial statements like the income statements, the cash flow, the balance sheet for this analysis. And the analyst will compare the ratios with similar firms in the industry, or they might analyze the company's trend over a period of time. Now, the purpose of the ratio analysis, business owners and management would use the ratio analysis to estimate their performance and create strategic planning. Investors would use these ratios to determine investment-worthy companies and also calculate returns. Creditors and lenders would use it before granting short-term and long-term debts. They study these ratios to know the liquidity and solvency of that organization. Okay. Now, these are examples which we already talked about before: current ratio, return on investment, price to earnings. This is an example of a liquidity ratio, profitability ratio, earnings ratio. And now here it says, what is ratio analysis in human resource management and its importance for effective human resource management? So turnover ratio, it indicates the rate at which employees leave the organization, and it helps identify issues with employee satisfaction and retention. Now, the training cost ratio, it reflects the investment in employee development relative to total HR cost. And it ensures the balance between cost management and talent development. Employee productivity ratio would measure the output in relation to the number of employees. And that informs decisions for optimizing workforce efficiency and output. The cost per hire assesses the average expense incurred to recruit a new employee, and it's useful for evaluating the efficiency of the hiring process. Now, revenue per employee gauges the financial contribution of each employee to the organization, and it's crucial for understanding the economic impact of human capital on performance. And like I said before, human capital is the economic value of those employees to the organization. Now, classification of ratio analysis, we touched on this before. The profitability ratios would evaluate the utilization of available resources to generate profit. Those ratios would include gross profit margin, return on equity. Liquidity ratios will quantify if the company can meet its current liabilities and debts. Working capital ratio, quick ratio. And you have solvency ratios. It evaluates the company's cash flow to predict if they can fulfill their debt commitments. It includes debt to equity ratio, debt to asset ratio. Then the turnover ratios, it tests asset management efficiency by evaluating revenue generation through asset utilization. It includes debt to equity ratio, debt to asset ratio as well. Now, the earning ratios help gauge returns on investment and calculate interest earnings. So that includes price to earnings ratios and earnings per share ratio. Now, limitations of ratio analysis is one, inflation. So while recording your financial statement, companies do not consider inflation, which can produce uncertain conclusions. Now, therefore, analysts should adjust the data as per inflation when analyzing ratios. Another limitation is analytical knowledge. So while examining companies and their financial statement, you need to have the appropriate analytical skills. Without the knowledge of quantitative analysis in these ratios, one may be prone to frequent errors. Another limitation is reliable data. Now, using out-of-date historical values may forecast inaccurate performance. Sometimes even the latest financial documents can be tampered with. Thus, the data can be unreliable. Now, accounting policies. So accounting policies and principles, they differ from different industries and from different countries as well. In companies within the same industry, and even when a company changes its policies over the years, therefore you cannot compare the ratio analysis results because of differences in accounting policies or principles. And the final limitation is interpretation. With different definitions of profits and valuation methods, we cannot compare companies enforcing differing concepts. So seasonal effect can also result in inefficient analytical outcomes.